We don't really see a need to handicap portfolios by making an outright call on a single equity style. If you look back at the beginning of this recovery, which really started in the beginning of November post the presidential election in the US, it was value, cyclicals, and small capitalization firms that really led the recovery, which is to be expected coming out of a recession. This return leadership persisted through the end of the first quarter and really the first half of the second quarter as well. But we have been seeing a little bit of a rotation in the last month and a half. It's been more of an emphasis on large caps, on growth-oriented equities, and we do think that this tug of war between growth and value will persist through the second half of this year. We think that focusing on quality in portfolios will prove more prudent for the second half of this year. First and foremost, quality stocks are always in style, and that's because of the client experience that they provide. That client experience is a combination of upside participation, but also an emphasis on downside protection or capital resiliency. So when you combine those two aspects, what an investor receives is strong risk-adjusted returns over the long term. So not just the fact that investing with quality in mind is a go anywhere, do anything strategy on the equity side of the book, it's also pretty timely. So we certainly saw those value cyclical names really rip higher off the bottom. That was necessary as they were at very depressed valuations. However, in this mid-cycle sweet spot that we kind of find ourselves in now, to get another leg higher, companies are really going to have to display strong earnings, free cash flow growth, and really just a generally resilient margins. And so companies that can do that are what we would define as quality. And it's really going to shine through which companies are able to be resilient and which companies are not.